Where should you invest? What sector generates the biggest cash flow? Despite what many might think, it is in finance, technology, electric cars, AI, or even space. The true money-generating machine is an investment in fossil fuels. Now, the energy sector is one of the cheapest one in the S&P 500 index. Still, it creates the most cash flow per share, and the wealthiest people are already leveraging this.
Warren Buffett continuing to view the energy sector as an opportunity for him to put some cash to work.
Can you also invest in fossil fuels and make a steady profit? Yes, and today you will learn how. Coal, natural gas, and petroleum, all of these are fossil fuels. They come from ancient plants and animals that lived on our Earth millions of years ago. And now, thanks to them, we can use fossil fuels as our energy source and a cash-generating investment. Unfortunately, their supply is finite, unlike renewable energy sources. No matter how much we talk about renewables, fossil fuels are still essential for our world today. For many years, they were driving our global economy, powering industries, transportation, and infrastructure. And fossil fuels are still the primary source of electricity generation. For example, today, almost 60% of all electricity is produced using fossils. Experts predict that global electricity production will rise around 70% in the next 30 years. But the question is, can we come up with an effective and sustainable green energy sources to cover all of these needs? Many doubt this and claim that investments in fossils will either grow or remain steady for the next 30 years, reaching $15.5 trillion by 2050. Even by the end of this year, global fossil fuels investments will reach over $1 trillion, which is 40% less than in clean energy. Due to the increase in fuel prices, 2022 was profitable for many energy companies. Total net earnings from fossil fuel sales more than double compared to recent years. The global oil and gas producers earned over $4 trillion. No wonder why people still want to invest in the industry. When it comes to energy investments, the oil sector takes the lead, making up around 85% of the fossil funding. But people started integrating these energy sources into their lives a long time ago. For example, coal has a history of usage for heating dating back to prehistoric times. Archaeological findings show that even the ancient Romans used coal in England during the 2nd and 3rd centuries. While back around 500 years BC, the Chinese used simple bamboo pipelines to transport natural gas that seeped to the surface. They even utilized this gas to boil seawater, making it drinkable. No matter how long the history of fossil fuels is, today, we constantly hear people fighting against non-renewable energy sources.
We have to end fossil fuel subsidies, stop new exploration and extraction completely.
Especially the top East Asian fossil fuel financiers, stop funding fossil fuel projects.
No investment on fossil fuel.
Today, more and more people and proactive organizations advocate against fossil fuels and suggest investing in green energy instead. But sometimes this doesn't work as expected. Imagine you invest in ecological and socially responsible funds. These are also known as ESG, environmental, social, and governance. You will expect them to buy stocks of anything related to renewables and clean energy. But the reality is different. Several green funds jointly invested $1.5 billion in fossil fuel companies in just 2 months of 2023. Why would they do something like that? The answer is simple: high returns. But we'll get to that in a moment. For now, let's see what's the challenge with environmental movements. Even though eco-activists all over the world call on companies and people to stop investing in oil and gas, the issue is that giving up non-renewable energy sources completely is impossible right now. We often hear that we're moving towards net zero emissions. Still, many experts say that if we stop all investments in fossil fuels overnight, the result might be catastrophic, because we won't be able to cover the energy demand with the existing green sources. And this will only lead to shortages and increased prices as the demand will be much higher than the supply. So humans have long learned to use natural fossils to improve their living conditions. And today, despite all the net zero sources, people still invest in them.
Energy's been an amazing bet, and I think energy is going to continue to be an amazing bet.
So why is the energy sector growing despite everything? The answer is quite simple. The energy sector stands out as the most affordable one in the S&P 500. At the same time, it generates the highest amount of cash compared to other industries. At the beginning of the pandemic, Warren Buffett made an investment of over $40 billion in the oil and gas sector. And it turned out to be a lucrative move as the industry showed record earnings in 2022. Despite the opportunity to make a substantial profit by selling, Buffett is choosing to continue funding the industry. This means that he believes in the sector's growth. Besides, his company, Berkshire Hathaway, owns over 20% of Occidental Petroleum. Big banks around the world have also put over $4.5 trillion towards oil, coal, and gas companies in 2015. For example, JP Morgan Chase alone increased its fossil fuel fundings by over $10 billion in the last 3 years. During the same period, Wells Fargo invested $19.5 billion into the sector. But not only the rich and famous can invest in fossils, you and I can also do that. Let's take oil as an example of a fossil fuel you can invest in. As we mentioned, it covers 85% of the world's energy needs, and the production is pretty consistent over the years. This means that demand for oil investment is likely to stay high in the future. Oil investments alone will reach over $10 trillion in the next 3 decades. This is still possible because of the strong demand for oil products, especially in the petrochemical industry. Does this mean that investing in fossil fuels is still relevant? Yes, it does. But before doing that, you have to know some crucial things. First, when we are talking about the price of oil, it is better to keep in mind that there isn't just one price tag. In reality, there are over 150 different oil blends and indices, each of them with its own cost fluctuations. That makes the oil market more complex without a single unified price. In fact, oil trading is often compared to the stock market because of all the diversity and unique market behavior. When considering oil investing, seeking assistance from both an independent financial advisor, IFA, and a specialized oil broker or stockbroker can be beneficial. IFAs typically do not recommend specific stocks or shares, but they can help you to assess the amount of risk you can comfortably handle and how much money you can reasonably invest in the oil market. There's some other things you should know about before investing in oil. For example, the factor that influence oil prices. Mainly, it is a mix of supply and demand. When more people need oil and there's less available, the prices go up. At the same time, when fewer people need it, prices dropped. Also, big events like COVID-19, Brexit, or conflicts between countries can affect prices. Another factor that influences price is the big players in the oil production industry. This is OPEC, the Organization of Petroleum Exporting Countries. It is a group of major oil producers like Saudi Arabia, the United Arab Emirates, Venezuela, and others. Together, they make up about 3/4 of the world's oil reserves and almost half of its production. This organization can impact global oil prices by simply increasing or decreasing the supply. But they don't have full control of the market because there are other big players, such as the US, for example. American production is based on new sources, and it's steadily growing over the last few years. That makes it challenging for OPEC to control the industry. Now that we understand the factors affecting prices, let's see different opportunities for how you can invest in oil. The first option is an indirect investment. To invest in oil indirectly, you should buy shares in oil companies like ExxonMobil or BP. If you can endure potential fluctuations and have a long-term investment mindset, investing in such companies might offer you a great addition to your investment portfolio. The next possible way to invest in oil is through exchange-traded funds, ETFs. This is a direct type of investment. It allows investing in a specific oil type, such as Brent crude oil. Similar to stocks, ETFs are traded on their own stock exchange. This option allows more flexibility in buying and selling your assets. The ETFs are suitable for investors who want short-term or liquid investments. Another option is to invest in an ETF that includes various energy commodities. They could have natural gas and heating oil shares. Investing through a broader focus ETFs might provide some protection from market volatility, but it's essential to remember that it still carries certain risks because of the ETF's stock exchange trading. The ETF's value changes during the day with market shifts. If the market goes down, their price can quickly decrease, so this could lead to potential losses. Oil futures are another investment option. In this strategy, a buyer tries to predict the future cost of the commodity and commits to purchasing oil stocks at a specific price when the futures contract matures. But it is one of the riskiest investment opportunities because you must pay for your stocks even if the market prices differ significantly from what you predicted. This makes it similar to gambling and leads to potentially significant wins or losses for the buyer and seller. It all depends on how the price changes. Let's discover a practical example. Just imagine that currently the price of heating oil is $2.50 per gallon. You expect it to rise in the next few months. You enter into a futures contract to buy 1,000 gallons of heating oil at $2.50 per gallon for delivery in 4 months. If the price of heating oil has gone up to $3 per gallon, you've made a good move. You can purchase the oil at the lower contracted price of $2.50 per gallon and avoid paying the higher market price, saving you money. Yet, if the price drops to $2, you will end up paying a higher price. Finally, you can invest in oil options. They give you the opportunity to buy or sell oil at a predetermined price. Unlike futures contracts, there is no obligation to go through with the transaction. So it is a less risky investment. You can decide to proceed by the expiration date, but to back out, you will need to pay a premium. Let's imagine that the price of gasoline is $3 per gallon. The price might rise in the next few months. You purchase an oil call option at a strike price of $3.20 per gallon. This gives you the right but not the obligation to buy 1,000 gallons of gasoline at the price in a few months. If the price of gasoline has increased to $3.50 per gallon, your option becomes valuable. You can exercise your right to buy gasoline at the lower strike price of $3.20 per gallon and save on the higher market price. Still, investing in fossil fuels has positive and negative aspects. On the positive side, fossil fuel industries are well developed. They offer a cheap and reliable source of energy. Besides, they're still in high demand. However, there are significant drawbacks to these investments. Fossil fuels are non-renewable resources. That means their availability is limited. They cannot be replaced once depleted. Additionally, many claim that their combustion contributes to climate change. The sustainability of fossil fuels industry is also a concern, as their long-term viability is questionable. That's why you can encounter protests from eco-activists that are calling for a policy of disinvestment in fossil fuels. Despite these issues, such investments have high returns. And as the energy sector isn't the most popular one, it means that there are more investment opportunities. Besides, everything shows that fossil fuels won't be replaced as a primary energy source in the next decades. What do you think about this investment? Have you ever thought about getting into the energy sector? Feel free to share this video and your thoughts in the comments. See you in the next video. Bye-bye.